Picture the scene. It's the fall of 2008 and global markets are failing. Lehman Brothers, an investment bank with $600 billion in assets, has just filed for bankruptcy, and the US economy is crashing, with unemployment rates that will reach as high as 10%. 2 weeks later, on September 29th, the US stock market loses $1.2 trillion in value in a single day, as the Dow drops by nearly 7%. The crash has caused widespread panic in the markets, and wherever you look, people are selling and selling fast. It doesn't matter what they hold, they're selling it. And yet, while others are panic selling, one big investor has a different outlook: Berkshire Hathaway CEO Warren Buffett. The billionaire investor isn't panicking about the market crash and offloading all his stocks. In fact, he is buying more. Buffett has spotted a golden opportunity in the market to make serious money. An opportunity that will go on to earn him more than $10 billion. In this video, we'll share why Warren Buffett sees market crashes as such tremendous wealth-building opportunities, what he did to exploit that opportunity in 2008, and what you can do this year to profit from the challenging economic times that we currently find ourselves in. But first, let's bring it back to the present day. As you may know, the economic climate that we're currently experiencing is one of the most challenging that we have seen for many years. Having reached a 40-year high in June 2022, inflation remains a serious issue in the US economy and is still not fully under control. In order to combat inflation and bring prices back under control, the Federal Reserve, the US central bank, has aggressively increased interest rates to their highest levels in 20 years. As you can see from this chart, after 40 years of declining, or almost zero interest rates, the Fed has been increasing interest rates since early 2022, with significant increases in December 2022 and early 2023. Interest rates are basically the cost of borrowing money, so higher interest rates make borrowing more expensive, which in turn reduces spending and investment. By curbing excessive spending, the Fed aims to keep prices stable and prevent inflation from spiraling out of control. However, the combination of high interest rates and high inflation are currently grinding the economy to a halt. High inflation erodes purchasing power, meaning consumers can buy less with the same amount of money. When interest rates are also high, borrowing costs increase, making loans more expensive, which can discourage investment and spending by businesses. Consumer spending is further discouraged, as consumers can now earn more from keeping their money in a savings account. Lower consumer spending can lead to reduced sales and profits for businesses, meaning businesses begin to suffer. Listed companies may miss their earnings targets and stock prices begin to fall. As stock prices fall, there may be fewer opportunities for profitable investments, affecting entire stock markets and investment portfolios. So how can any opportunities possibly exist in such doom and gloom? Well, to understand how Warren Buffett sees such opportunities in market downturns, you must first understand Buffett's fundamental approach to investing. This investment philosophy is known as value investing. Value investing is an investment strategy where you look for stocks that are selling for less than what they're actually worth, or in other words, those that are undervalued. Because they are undervalued, value investors can buy shares in these companies at a low price. Once they've bought the shares, they then wait for the market to realize the true value of these companies, which can lead to large profits when the stock prices rise. In other words, value investors like Buffett are bargain hunters. They seek out opportunities where the market has underestimated the intrinsic worth of a company, allowing them to buy stocks at a discount, knowing their true value will eventually be recognized by the market. Let's use an example to illustrate this point. Meet John, an avid car enthusiast who has always dreamed of owning a classic collectible car. John is also a savvy investor who understands the principles of value investing. During a recession when the economy is struggling, car prices are falling and collectors are panicking and selling their cars. John sees an opportunity to fulfill his dream while also making a smart investment. John does his research and identifies a rare vintage car that he's been eyeing for years. Due to the economic downturn, the car's price has dropped significantly, making it more affordable than ever before. Recognizing the potential for long-term value, John decides to take the plunge and purchase the car while it's still undervalued, purchasing the collectible car at a steep discount compared to its pre-recession price. Several years later, John's foresight and patience pay off. The economy has fully recovered and the demand for collectible cars is stronger than ever. The rare vintage car that John purchased during the recession has become highly sought after by collectors, driving its price to new heights. John, recognizing the opportunity to capitalize on his investment, decides to sell the collectible car for a significant profit. Thanks to his value investing approach, John not only fulfilled his dream of owning a classic car, but also turned it into a lucrative investment that yielded a huge return when the markets recovered. This example illustrates why Warren Buffett is such a staunch advocate for value investing. Buffett's investment philosophy is rooted in the belief that over the long term, the market tends to correct itself and recognize the true value of quality companies. Instead of chasing after the latest hot stocks or trying to time the market, Buffett focuses on buying companies with solid fundamentals, such as strong balance sheets and consistent earnings growth, strong competitive advantages in their industry, and attractive valuations, such as stocks that are trading below their intrinsic value. As Buffett famously once said, "Price is what you pay, value is what you get." One of the key principles of value investing is patience. Buffett is known for his long-term approach to investing, often holding on to his investments for years, even decades. By exercising patience and discipline, Buffett is able to ride out short-term market fluctuations and capitalize on the long-term growth potential of his investments. This steadfast commitment to his investment principles has helped Buffett generate exceptional returns over the years. And if you want to learn more about long-term investing, don't forget to subscribe as I'll be talking more about it in upcoming videos. Now, let's rewind to the fall of 2008, a time of economic turmoil and uncertainty. How did Warren Buffett profit so handsomely from an economic crisis that he himself described as an economic Pearl Harbor? Well, Buffett has a famous saying, "Be fearful when others are greedy, and be greedy when others are fearful." Whether it was Black Monday in 1987 or the dot-com bubble burst in 2000, Buffett has a track record of capitalizing on market downturns. His strategy has proven successful time and time again, and the 2008 financial crisis was no different. Instead of succumbing to fear and panic like many investors, Buffett remained calm and collected. He saw the crisis as a chance to deploy capital into undervalued assets with strong fundamentals. As Buffett put it, "Fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have. But most major companies will be setting new profit records 5, 10, and 20 years from now." Two prime examples of Buffett's strategic investments during the 2008 crisis were Goldman Sachs and General Electric. In September 2008, the same month that Lehman Brothers was filing for bankruptcy, Buffett invested $5 billion into one of the largest investment banks in the world, Goldman Sachs. He did so because he saw an opportunity to provide capital to a solid institution in need while securing favorable terms for Berkshire Hathaway. Here's why it was a smart move. Buffett's investment was seen as a vote of confidence in the financial markets during a time of extreme uncertainty. And because of the extreme uncertainty, Buffett was able to invest with very favorable terms, with Berkshire Hathaway securing $5 billion in preferred stock, which paid a 10% annual dividend, as well as receiving warrants to buy additional stock at a discounted rate. Buffett's decision reflected his long-term investment strategy and belief in the resilience and recovery of Goldman Sachs, and the American economy. This move provided much-needed capital to the investment bank during a time of crisis, and in return, Buffett generated substantial returns for Berkshire Hathaway and its shareholders. Similarly, Buffett also made a $3 billion investment in General Electric, or GE, the US multinational conglomerate, which was also struggling amidst the financial turmoil. This investment was strategic for several reasons. GE needed vital cash as credit markets seized up and global demand slumped. Buffett's investment provided that much-needed liquidity. Again, the market uncertainty meant that Buffett was able to secure favorable terms, securing $3 billion in preferred stock, paying a 10% dividend, plus stock warrants to buy additional stock at a discounted rate. Again, Buffett's backing was seen as a strong vote of confidence in GE's future, which was important for the company's image and stability during the crisis. Buffett believed in the long-term success of GE, which aligned with his investment philosophy of committing to companies with strong fundamentals and potential for recovery, even when markets are panicking and everyone else is selling. The combined success of these investments is thought to have earned Buffett and Berkshire Hathaway profits in excess of $10 billion. Now, you may be thinking, that's all great, but I don't have a spare few billion just lying around ready to invest. Well, the beauty of Buffett's investing philosophy is that it can be applied by anyone, no matter how much or how little you have to invest. So, let's look at the strategies you can apply to build transformational wealth during these uncertain economic times. Strategy 1. Hold cash. When it comes to market crashes, one of Warren Buffett's go-to strategies is to hold cash. Now you might be wondering why cash is king during turbulent times? Well, think of it this way. When the market takes a nosedive, prices of stocks often plummet. Having cash on hand will allow you to seize incredible buying opportunities when others are selling in panic. Whether it's buying shares of strong companies at discounted prices or investing in undervalued sectors, cash gives you the flexibility to capitalize on these opportunities when others are fleeing the market. Warren Buffett famously said, "Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble." In other words, when the market presents you with opportunities to buy great companies at low prices, you want to be ready to take full advantage. By holding cash, you can resist the temptation to chase after every market trend or hot stock. Instead, you can wait patiently for the right opportunities to come along, knowing that you have the financial firepower to act decisively when the time is right. So, if you're looking to position yourself for success as an investor, don't underestimate the importance of holding cash. It could be the key to profiting from market crashes and building long-term wealth. Strategy 2. Sell overvalued stocks. Another key strategy in Buffett's playbook during a market crash is to sell overvalued stocks. Now, this might seem counterintuitive at first. After all, shouldn't you hold on to your investments for the long term? Well, here's the thing. During market booms, some stocks can become significantly overvalued. Overvalued stocks are those whose prices have risen to levels that exceed their intrinsic value. This can happen for a variety of reasons, including investor speculation, market euphoria, or simply an incorrect assessment of a company's fundamentals. During bull markets, when stock prices are rising, it's easy for investors to become complacent and ignore warning signs of overvaluation. But when the market inevitably corrects itself, overvalued stocks can be hit the hardest. One of the main reasons why you should sell overvalued stocks during a market crash is to mitigate risk and protect your portfolio. By selling off overvalued stocks before or during a market crash, you can reduce your exposure to these high-risk assets and preserve capital that can be reinvested in undervalued opportunities or used to weather the storm. Buffett once said, "Our favorite holding period is forever." But that doesn't mean he's against selling when the situation calls for it. By selling overvalued stocks during a market crash, you can protect your capital, limit your long-term losses, and position yourself for future opportunities. Strategy 3. Invest in value for the long term. During a market crash, prices may be depressed, but the underlying value of quality companies remains intact. So, when the market crashes, you need to be buying the dip. As Warren Buffett put it, whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. As a result, you should look to invest in companies with strong fundamentals, sustainable competitive advantages, and attractive valuations. These are the kinds of companies that can weather the storm and emerge stronger on the other side. One of the key reasons why investing in value is so powerful is because it encourages a long-term perspective. Unlike short-term traders who focus on timing the market or chasing after the latest trends, value investors take a patient and disciplined approach to investing. Instead of worrying about day-to-day fluctuations in stock prices, value investors focus on the underlying fundamentals of the companies they're investing in. They look for businesses with strong competitive advantages, consistent earnings growth, and attractive valuations. And they're willing to hold on to these investments for years, if not decades. By focusing on buying quality assets at bargain prices, maintaining a long-term perspective, and capitalizing on market inefficiencies, value investors can potentially generate superior returns and build a more resilient portfolio over time. Strategy 4. Diversify your investments. Diversifying your investment is equally important. It means spreading your money across different types of investments. Instead of putting all your eggs in one basket, you place them in several. This way, if one investment doesn't do well, you have others that might be performing better. You can diversify your investments in many ways. This includes investing in different industries, different types of assets, and even in different countries. This strategy helps to reduce the risk of losing money and can lead to more consistent growth over time. But remember, diversifying doesn't mean investing in anything and everything. It's about making informed choices based on research and perhaps advice from financial experts. Also, you'll never eliminate risk completely. Any investment can go up or down in value, and you could make or lose money. The key is to find an appropriate spread of investments and a level of risk and return that you are comfortable with. So, there you have it. Warren Buffett's strategies for maximizing the massive opportunity that the current economic uncertainty is presenting for investors to build wealth and get rich. If you want to learn more about the assets you need to be buying to become a millionaire in 2024, head on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.